Good morning. We're still in chapter 1 here. We're still on the first day. That's my favorite picture of myself and Christy, my oldest daughter. Christy, as I said, works or lives in Arlington, Virginia, just outside of Washington, D.C. She actually works in a company in Maryland, uh, Institutional Shareholder Services. They evaluate companies based off environment, sustainability, and governance. So she's, by my standards, knowledgeable about the environment, sustainability, and governance. But that's my favorite picture with Christy. This is an old slide. It came from information in a previous edition of the book. Uh, I'm probably biased. Cynthia Cooper came to speak to our Cal Poly a few years ago. But the thing I want to show, this was 2001. This was WorldCom. And what they did is they just made adjusting entries to reverse an expense. So they just made adjusting entries, debit, asset, credit, expense. And they did it for over $3 billion. Cynthia Cooper was in charge of their internal audit, and she detected the fraud, and off we go. She was Times Person of the Year, Woman of the Year that year. But it was interesting to hear her speak, and there were several things. But one that resonated with me is Bernie Ebbers was the CEO and chairman of WorldCom, and she said Bernie's a good guy. He sat 2 pews in front of her on church and went to church every Sunday and blah, blah, blah. So she said, it's a good guy, and he truly believed. So he had a net worth of over $1 billion. He never sold a share of WorldCom stock. As WorldCom went bankrupt, as he went to jail, he held on to his stock because he truly believed WorldCom was a good thing. The other thing that she pointed out, WorldCom was headquartered in Mississippi, a town in Mississippi not that much bigger than San Luis Obispo. Think what an impact a Fortune 100 company would have on San Luis Obispo. So everybody in that little town either worked for WorldCom or knew somebody that did. So when she blew the whistle on WorldCom, she knew that she was putting friends and family out of work. She was disrupting the lives of many people for whom she cared a great deal about. But she went ahead and did the right thing. Here's a table out of your book of the failings in 2008, 2009, the Great Recession. I want you to look at two things here. The largest investor losses were AIG and Citicorp, far and away. They were audited by PwC and KPMG. The auditor that took the biggest hit was probably EY. And this is not a political argument or a political statement, but just to point out the way life works sometimes. So if now look at who audits who. So PwC audited Bank of America and JP Morgan Chase. KPMG audits Citicorp and Wells Fargo. Those are the four big banks. AIG was bailed out. So PwC audited AIG. They were bailed out. And now they have repaid the government for the bailout. Then you got Lehman Brothers, which was allowed to go bankrupt. That's what hit EY so hard, was Lehman Brothers was allowed to go bankrupt. Goldman Sachs and Morgan Stanley eventually were rolled into FDIC, were eventually covered by FDIC insurance. Don't ask me why. Um, Bear Stearns got sold, or the assets of Bear Stearns were bought by J.P. Morgan. The assets of Merrill Lynch were bought by Bank of America. The assets of Washington Mutual were bought by J.P. Morgan. The assets of Countrywide were bought by Bank of America. Now, the reason those are purple is because the J.P. Morgan and Bank of America were audited by Price Waterhouse. So throughout this whole fiasco, Price Waterhouse audit base actually increased. And it was a PwC partner that pointed this out to me. He said it was 2009 or 10, and he pointed out to me, he says, we don't say this out loud because so many people were hurt, but he says we probably actually benefited from the financial collapse, just where the different firms ended up. The fact that Bear Stearns, Merrill Lynch, Washington Mutual, Countrywide all ended up going to banks that were audited by Price Waterhouse. And again, the only reason I point this out, I'm not trying to do right or wrong or who's better, who's taller, who's shorter. It's simply, guys, things, the cards fall in many ways, and you never know exactly who this can be benefited and how. Normally, if we were in class, I'd put a question up on the board like this, and then your name would pop up, and you'd be expected to answer. Well, I can't quite play that game in this environment, but I want you to know that this class is built off of question and answers. So that's how we would like to do it. Auditing. Definition of auditing: accumulation and evaluation of evidence about information to determine and report the degree of correspondence between the information established. That looks like a bunch of words to me. And I had to think long and hard about the accumulation and evaluation of evidence about information. That information is the financial statements. The accumulation and evaluation of evidence about the financial statements to determine and report on the degree of correspondence between the financial statements and GAAP. Established criteria is GAAP. So then it starts to make sense to me. In our world, auditing can be things other than financial statements. They audited the results of the election in various states. Okay, but we're worried about financial statements. So this is a generic definition of auditing, gathering evidence to determine the correspondence between evidence and established criteria. You have to have established criteria. So in our case, it's the accumulation and evaluation of evidence about the financial statements to determine and report the degree of correspondence between the financial statements and generally accepted accounting principles. Now that definition makes a little sense to me. Audit evidence. This is the definition from the AICPA. Now remember, this is a definition. Later on, we're going to talk about an objective. So the definition is information used by the auditor in arriving at the conclusion on which the auditor's opinion is based. Information used by the auditor to arrive at conclusions on which the auditor's opinion is based. Audit evidence is information to which audit procedures have been applied and consists of information that corroborates or contradicts assertions in the financial statements. So it's information used to base our opinion on, our conclusions on. It's information to which audit procedures have been applied. So we've audited the information. And finally, it can either corroborate the assertions in the financial statements or contradict the assertions in the financial statements. 315. This is one of my favorites, right? Identify and assess the risk of material misstatement, whether due to fraud or error at the financial statement. Well, I'm old and I don't have a very good memory, right? So I know you guys can blast through this. You got great memories. I'm jealous, but I'd rather have you learn it. And by learn it, I want you to think, what's it mean? What are so there's 4 pieces to 315, I think. If I'm trying to learn it, I'm going to break it down to the pieces, right? Identify and assess the risk of material misstatement. Now, I said earlier, anytime I say material misstatement, I'm probably going to add whether due to fraud or error. That's not 100% true, but it seems to be almost. Identify and assess the risk of material misstatement at the financial statement and relevant assertion level. Well, the financial statements are kind of big to audit. So we break it down to relevant assertions. We break it down to the assertions. And most of the time we're actually auditing an individual assertion rather than the financial statements as a whole. How do we do that? By understanding the entity, its environment, including its internal controls. Thereby, that understanding will provide a basis for designing and implementing responses to the assessed risk of material misstatement. So to me, there's 4 pieces to this puzzle. Identify and assess the risk of material misstatement at both the financial statement and the relevant assertion levels. How do I do that? By understanding the entity, its environment, and its internal control. Hopefully this will provide a basis to design and implement responses to that assessed risk of material misstatement. So if I think about it piece by piece, it starts to make sense to me, which is a little better than memorizing. Now, I know your job is to get an A on the test. My job is to try and trick you into learning something. So what I would ask is, as you're studying, think about what it means. Think about the 4 pieces to this puzzle. And then the night before the test, you can just memorize to get your A. That's fine. 330, this is not a memorized one, but I want to stress this and make sure it comes through. Obtain sufficient appropriate audit evidence. That's a buzzword. That comes out a lot. Sufficient appropriate audit evidence. We'll see that a lot. Regarding the assessed risk of material misstatement, ROM, that comes out a lot. Through designing and implement appropriate responses to that risk. Now, this is not a memorize, like I said, but I want to get it through your head that an audit is a response to risks. Okay, we audit accounts different if there's a significant risk of material misstatement than if there's a low risk of material misstatement. So we identify and assess the risks, and then we design responses to those risks. So an audit is responding to risk. Number 500, audit evidence. This is one of my favorites too, but this is going to be hard for me. You're going to have to watch me. This was changed. So the reason I went back and redid all these slides is because of this one paragraph. So, but it's one of my favorites. I'll stumble over the words. I have to learn it along with you. Number 5, or audit objective 500, relates to audit evidence. Evaluate information to be used as audit evidence, including the results of audit procedures, to inform the auditor's overall conclusion about whether sufficient appropriate audit evidence has been obtained. The question is whether sufficient appropriate audit evidence has been obtained. We can't express an opinion unless sufficient appropriate audit evidence has been obtained. So again, to me, there's 4 pieces to this little puzzle. Evaluate information to be used as audit evidence. So what is our body of evidence? What are we using as evidence? Including the results of our audit procedures. Well, previously we learned that audit evidence is information to which audit procedures have been applied. To inform the auditor's conclusion whether sufficient appropriate evidence has been obtained. Okay, so do we have sufficient appropriate evidence to support our conclusion on the financial statements? So 500's a biggie. Independence. Now, this is really the principle we're going to learn later on. This is the principle of objectivity in independence. Ted teaches it as the definition of independence. That's not right, but I'm writing the test, so accept it. A member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. A member in public practice should be independent in fact and appearance when providing professional auditing or attestation services. Now, the reason that I want to use this as my definition is because I want to stress the standards are different for auditors than they might be for consultants or tax people. So a member is a member of the AICPA. So wherever we see member, it's a member of the AICPA. Remember, what we're going to learn this quarter are primarily the auditing standards from the AICPA. The auditing standards, the AICPA issues auditing standards for private companies. The PCAOB issues auditing standards for public companies. Most of what we're going to learn is from the AICPA. Don't worry, most of it's pretty similar. But this definition, so this is the definition we're going to use. A member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. That's all members of the AICPA, whether they're in tax, whether they're in consulting, whether they're in industry. A member of the AICPA should maintain objectivity and be free of conflict. Okay, so that first part applies to all members of the AICPA. That's objectivity. The second part, a member in public practice should be independent in fact and appearance when providing professional auditing or attestation services. So the standards are a little bit higher for auditors. My daughter Lindsay, I've told you, is a tax accountant at Grant Thornton. And so for her tax clients, she does not have to be independent. Often she helps the audit team audit income tax expense. When she's helping the audit team audit income tax expense, she becomes effectively an auditor. And then that second sentence applies to her also. We believe independence enhances the auditor's ability to act with integrity and be objective, to maintain an attitude of professional skepticism. Okay, we think it's easier to be objective and be skeptical when we're independent. It's easier to tell that a stranger violated the law than it is to turn in a good friend. Independence in fact, independence in appearance. Now, sometimes you'll see independence of mind and independence of appearance. I don't care whether it's fact or mind. It's the same thing. Page 166, Table 6.3, one of my favorites. Here are the 6 assertions that you have to master before the first test. Okay, so you got one column there for transactions and one column for balances. Occurrence, completeness, accuracy relate to transactions. Existence, completeness, accuracy, valuation, and allocation apply to balances. I thank you very much, and I look forward to seeing you shortly.